Welcome to Stocks in Translation, your essential conversation cutting through the market mayhem, the noisy numbers, and hyperbole to bring you the information you need for your portfolio. Today, I am joined by Jay Hatfield. He is Infrastructure Capital Advisors CEO and also the CIO of ticker SCAP, and Brooke DiPalma, Yahoo Finance's own. Thank you for joining us here today. Here's what we're going to talk about. On the docket, we're going to talk about central banks. Don't fight the ECB. Guess what? That's what our guest Jay says. And our word of the day is liquidity, kind of a loaded term that can mean a lot of things, and we're going to break down as much as possible. Also, this episode is brought to you by the number 2, and that's because the 2%, that's the Fed's inflation target, and we're going to ask, is it ripe for disruption? Now, Jay, we want to focus on central banks here. So tell us, where do you think we are globally? Because this is a global phenomenon. All these central banks act independently, but they do confer with each other. And the ECB, you're saying the ECB might move first.
Yes, thanks, Jared and Brooke. It's great to be on. So we have a totally differentiated view of economics and the market because we focus on the money supply. And surprisingly, the Fed does not. In fact, the Fed chair said it doesn't matter. And so why that's important, normally you can ignore the money supply because it just sort of moves up with GDP, nominal GDP. But when the Fed intervenes like it did during the pandemic, you have to follow the money supply. So if you did that, by the way, you would have traded the market absolutely perfectly. And if you go back and look, most of our calls were pretty spot on because we were looking at monetary policy and the Fed was not. So they were calling it transitory. So that's the most important thing is to focus on that. Recently, though, remember we had a big run-up in interest rates last year in October. We started to get a little bit smarter because we try to adapt to the markets. And so what we did is say, well, why are rates going so high? And what we realized is the ECB had actually taken $700 million of liquidity out within a week. So, and they need to do that.
I missed that.
Yes, well, everybody did. In fact, we just uncovered it by looking. And then we started publishing the global monetary base, which you can only find on our website. All it is adding all the money supplies throughout the world. And so since then, we really started focusing on Europe. And our real thesis was that, every time there's a Fed tightening cycle, something breaks, right? We can all remember, particularly me, who's older, like all of the breaks. So you have the .com, et cetera. Savings and loans.
It's what happens, typically.
Right. But so our thesis actually for quite a while has been what's going to break is Europe. And that's actually sort of good. I mean, not to wish them poorly. That's actually good for the U.S. because it's deflationary. And that's really what's happened. They have basically zero growth. So they're going to cut. In fact, Lagarde.
So they need to cut it.
Yeah, they have to. They have three other major countries are in recession. So it's a little bit different in the U.S. where pretty homogeneous. It's not true there. So Lagarde yesterday even repeated that she's essentially cutting. I mean, the way central bankers say, like it's almost 100% certainty. And so that makes sense because their inflation is plummeting. And so the recent data, and I didn't even know this or had memorized at least, is that the ECB is actually 30% of the global monetary base.
Is that bigger than the Fed?
Yeah, it's bigger. The U.S. is only 23. So
that's surprising.
The reason why this is an interesting or should be an interesting conversation is that it's easy and proper, really, to ignore the rest of the world when it comes to equities. Like NVIDIA is going to drive the Chinese tech market tomorrow.
And admittedly, that's what we're doing here. By the way, this is going to be released after the NVIDIA earnings, so we're not going to try to talk about it that much. But your point taken here, we're very U.S. Focused here in the U.S. because that's where the tech action is.
Right, and it drives the rest of the world. Like I've been in Europe trading stocks and say, oh my gosh, the European market's getting smashed. I better hedge my U.S. portfolio. And then the U.S. market opens, and they don't care what was going on.
No volatility, record highs.
They don't. Yeah, they're not focused on that. But you can't do that with bonds and the money supply because their bonds are very similar to ours. They don't have any tech stocks like ours, but their bonds, like UK gilts, are the same essentially as U.S. Treasuries. So you have to look at the global market when it comes to interest rates. We're very fixed income focused, so we care a lot about interest rates. And so the ECB is absolutely going to cut. And the second thing that no one ever talks about, and this also, we focused on this because I have some hedge fund friends and they're like, oh, I don't care if the Fed cuts 25, it's irrelevant. But there's no dial in the New York Fed to lower rates. In other words, they have to inject liquidity into the banking system
That's
to lower the overnight rate.
Yeah.
Yeah, go ahead, Brooke.
Jay, break down for people, maybe this is the first time hearing it here. Does it matter who goes first, and how does that then impact what happens here in the
rate
U.S.?
cuts, who's cutting first?
Yeah, so
Yeah.
normally we wouldn't even have this conversation because the U.S. drives the whole rest of the world, 100%. Like
Now
in
you're
fact-
saying the opposite.
Yeah, well, right. So this is the first time in history. I mean, the ECB is not that old, but the first time in history where somebody else will lead. Like just to take the extreme example, Hong Kong has a dollar peg. So if we raise or cut, they do it like 10 seconds later because they just have to because they're pegging against the dollar. But everybody is kind of pegging against the dollar because you don't want your currency to get smashed, and that's highly inflationary. But in this case, the ECB is going to move first, which should cause the dollar to appreciate, even though it hasn't really been appreciated recently. But once they actually do and that liquidity is coming in, the dollar should strengthen, which in effect exports deflation to the U.S.
Okay. And for the record, I mean, U.S. has been exporting deflation to the rest of the world for decades now, just because of U.S. dollar hegemony. I really like where this conversation is going. I was just wondering if you could give us more of an overview of some of the different mechanisms by which these central banks operate, because you said the New York Fed doesn't have a button that says lower rates. Basically, they have to target the money supply. This is something that Volcker did back in the day. He did it explicitly. But the transmission mechanism is the Federal Reserve is going to buy bonds or they're going to sell them, let them roll off. And that's really what's at play here.
Right. And so the only complexity to that is they can do long-term bonds or short-term. So they're always doing short-term. It's called open market operations. They're always manipulating, well, that's probably too strong a word, but
I think it's
managing the Fed funds rate to be in the center of the range. So they're always trading with the street. And in fact, this is surprising, it hasn't happened before either. The Fed was injecting so much liquidity by buying long-term bonds. We got bullish when they announced that. But they did it so much, they actually had to neutralize it by borrowing it back from short term. So they were doing this long short-term trade. So that's the only thing you have to watch is just what part of the balance sheet are they using to inject the liquidity with.
That reminds me of something that I noticed early on. Well, this is actually after the fact, but it went on during the global financial crisis that the summer of 2008, okay, let me take us back. Bear Stearns had failed, but Lehman Brothers had not failed yet. And everybody around the world was thinking, all right, the U.S. is going to raise rates. They're going to drive the bus, and we're going to embark on this interest rate hiking cycle now. Right. But it turns out the Fed wasn't done because they had enacted all these emergency lending facilities, and there was $300 billion shoveled over here, but then they had to take $300 billion over here. So they were selling treasury bills that had a huge liquidity draining effect. Right. And the net is that, well, Lehman Brothers failed. Was it direct? I don't know. But there was a liquidity crisis right after everybody thought things were going to be okay. Right. And I'm wondering, does that apply now?
Well, I think the first thing I'd say is that very few people appreciate that the Fed, with their 2% target, made the great financial crisis dramatically worse. And there's now research papers that demonstrate that. So the 2% target was way too low. So we all kind of forgot, but the Fed raised rates 17 times in a row because inflation was right at the target. So it didn't used to be an averaging target, it was the limit. So they did create a liquidity squeeze. And to your point, we do believe, we've been very bullish about the economy over the last 3 years because of the cyclical industries, housing and autos, had a shortage. But now there isn't a shortage and it's starting to roll over. So we do believe, which is a bit non-consensus, the Fed does not cut rates and increase liquidity, that we will have a mild recession next year as autos and housing continue to moderate, which does feed through to all the Lowe's and the other suppliers to the housing sector. Now, we think they are going to cut, so we'll be okay, but the global economy is slowing. If you look at the data, labor market's softening up. So we think the liquidity is needed at this point. If you just keep putting liquidity in, like in 2021, you get a lot of anomalies like meme stocks and
Yes.
Bitcoin going to forever. So you don't want to do it at the wrong time, which they were.
Jay,
But we think you need it now.
really quickly, where does that 2% target come from?
Yes.
So that's a great question. It was completely made up by the New Zealand Fed in the 70s.
I did not know it came from
Yeah.
New Zealand.
Right. So they just arbitrarily said, well, it's got to be above zero, so we'll pick 2. And it's really proven to be a disaster since that was enacted in the mid-2000s. It's terrible for the middle class. They don't want 10% inflation, just to be clear. That was horrible, particularly when it's
Because it punishes savers.
it does, and also it punishes people who don't own their own homes, and you're seeing that now, where the low-income consumer,
I
which
feel
is
it.
yes, well, I have a floating rate mortgage, so I get squeezed, but most people have fixed rate mortgages, so homeowners were crushing it. They're like, okay, my house, my housing prices are up 20%,
Yeah, it's
but
worth-
I'm not paying any more money. But most of the low-income people don't own their own house. Obviously, there's a few that do. So they're really getting smashed. So 10% is awful, but 3 or 4 is great because nominal rate wages go up, gives you more discretion. And so in other words, your wages go up and it gives you some discretion. Even if chicken's higher, you can buy something else. So nominal wages got smashed after that 2% target was enacted.
Where do you think we're at now in terms of inflation, in terms of everyday Americans being able to afford these goods? I mean, we're hitting on this. Beef is up. Everyday groceries are still up. They're still moving at a higher rate. So what does that signal for the Fed here?
Right. Well, the problem is the average consumer is not an economist. So, and what I mean by that
Is that a problem? I don't know. We end up with a lot of economists.
probably good. But the point being that, so we measure inflation over the last 12 months. But over the last 2 years or 3 years now, it's been horrible. So if you were in Arizona and your rents went up 30%, and your wages went up 15, it doesn't really matter that it stalled out and it's not going up that much.
Yeah.
So that's, I think, what the tale of two cities is that and this is a political issue too, of course, because a lot of lower income consumers are extremely unhappy.
Jay, I'm going to ask you to pause right there real quick. We need to take a break. But coming up, you don't want to miss another scintillating episode of Who Wore It Better? We are talking inflation. We're talking PCE versus CPI. You were just explaining the difference in how some of the housing components, some of the shelter components in PCE, which is a Fed's preferred gauge, are different from CPI. And that's kind of what I want to explore right now, those differences, because CPI gets the headlines. And to be fair, it's released 2 weeks earlier than PCE. So there's a little bit more data that we have for PCE. But what are the effects what's the effect that the Fed following PCE closer has on the market?
Mm-hmm. Well, we think that the Fed needs to be reformed, that their methodology, not just the 2% target, but just looking at PCE core is a mistake. And also to be so precise, like why not 2 to 3%? They're already doing averaging. And this notion that they can sort of perfectly land us at 2% is really ridiculous, we think. So that's the first problem. The issue with PCE, it's kind of interesting. In fact, the Fed chair told us last month, he told us what PCE would be a week before. I don't know if you noticed that. He said it's going to be flat.
I missed that.
Yeah,
Great.
so, but the reason for that is that, well, not anybody can do it, but we do it, it's not that hard, is you just take the components of CPI and PPI and then you weight them differently. And you can predict PCE core within 0.2 or so. Like, we don't think it's going to be that great. It's going to be 0.35 based on what's already come out. So that's strange. But the bad part about it, it's sort of good because it's a little bit less shelter, but which is good because shelter is distorted. It's 42% in PC headline, and it's about 15% core. So that's good. But when you take 7% and multiply it times 7 when it's really 0, that does raise the core rate by about 1%. And that's why we think inflation is contained, even though it's not reported that way. And the BLS number is used in PCE, just at a different weight.
I should add, there's a lot of controversy over the way inflation is measured, and I followed Shadow Stocks by John Williams' outfit back in the day during the global financial crisis. And, if you measure things a little bit differently, you can come up with some pretty different results. And it's a hot button issue because it affects people's pocketbook. Absolutely. And that's what we're talking about here. I want to move on to liquidity because that is our word of the day. And there are two main measures of liquidity here. Let me just get to the Investopedia definition, and I'll pull that up for you right in a second. Apologies for this. There we go. Investopedia says liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. And that's kind of key there. We can go into the different liquidity types and how it's used, but I just wanted to get your first blush impression here on liquidity.
Well, I think the most recent example of terrible liquidity was the pandemic.
Sure.
So during the pandemic, we would trade certain REITs. They'd be trading like, $100 stock would be trading like $4 wide. So liquidity did melt down during the pandemic. And in fact, I usually criticize the Fed, but it was great that they intervened and injected all that capital because we were going to crash. Like we were headed to like 11.
The economy was shut down.
Right.
That was a certainty.
The market was panicking. Everybody was selling. We were going to go to 1,100 on the S&P. So they did need to intervene because liquidity was horrible in all markets. Even large listed New York Stock Exchange. Now, I think there is a little bit some liquidity issues in the Treasury market, some on the off-the-run side, but the equity markets are functioning well, and having all these institutions, a lot of them in New York, these hedge funds doing trading, everybody sort of hates it, but it does provide a lot of liquidity to the markets.
We have different types of liquidity. So here's what I wanted to highlight. So we have it in order flow. So you were talking about buying and selling stocks. The instruments you were trading were $3 to $4 wide. That means we're talking about spreads here. And I would bet that those spreads are normally a couple pennies, so that you're paying basically somebody else that spread, that difference, for just executing the trade. And if you're on the other side and you're a market maker, that might work out well for you. But as a person who wants to own that thing, it could be a problem. And I think when we talk about central bank liquidity, central banks want to make sure there's enough cash in the system, and we've been talking about that. And then even in the capital markets, we talk about liquidity events. Well, guess what that is? That's an IPO. That's when companies bring their stock to market so that the insiders of whatever unicorn can get out. They have their liquidity. They get cash for their shares while the public starts owning the shares. Just wondering what you're observing in the market right now. How do you think stock liquidity is for investors? We just saw meme stocks, kind of explode. So maybe it's good. Is that a good thing?
Well, one point to make is that I think the explosion of ETFs is really around this liquidity issue because ETFs have market makers who are arbitraging the net asset value. And so what they do is they will, when a stock trades above par or fair value, they will sell it to whoever wants to buy it, and then they'll go and buy all the underlighters and then trade. We're ETF issuers, so they'll do a trade with us to offset it. So if you look at our ETFs, even the smaller ones, they'll trade like 4 or 5 cent wide with huge liquidity on both sides, and that's provided by the ETF providers. So because of that innovation of ETFs, the markets become much more liquid. And also investors get less nervous because it used to be like if all of your funds were Vanguard and you wanted to pull the plug, you put the order in, it doesn't get executed till the end of the day. So I think that ETF market, which now kind of dominates the capital market, has made the market significantly more liquid, and particularly for stocks that are in the indices, has improved liquidity.
Is there any type of liquidity that's not widely discussed that you think our viewers should be watching?
Well, the fixed income liquidity is still a problem.
And you were just alluding to that now.
Yeah.
And so is Powell, I think,
Right.
at various times over the last few years.
But bonds trade OTC, so they're just market makers. They don't have to post them.
Not on a centralized exchange
Right.
like stocks.
And so the investment banks will usually make markets that are a whole dollar wide, so you can sort of tell they're less liquid, right? Because that's like 1% of a $100 bond. So bonds are less liquid, although the market, I used to trade bonds about 15 years ago for a large hedge fund, and the liquidity was terrible then because there's no ETFs, there's no bond ETFs. Now the market making in the ETF bonds creates a lot more liquidity in the bond market. So you get sort of shadow liquidity through the ETF market, but it is difficult to trade individual bonds. The preferreds that we have in our funds, they're listed, so they're better, but actually our ETF is much easier to trade than the individual preferreds. And so preferreds act a little bit like these OTC bonds with wider bid-ask spreads and less liquidity.
It is time now for Who Wore It Better, and we have been talking about inflation, so guess what we're going to talk about here? Consumer price inflation, something we've discussed, is measured by the Bureau of Labor Statistics, while personal consumption expenditures, PCE, is computed by the Bureau of Economic Research. It accounts for shelter, these components a little bit differently. We've been discussing that. But we've also seen both of these inflation measures tick down considerably from their pandemic highs. So you take CPI, it peaked at 9.1% in 2022. It is down to 3.4%. PCE, the Fed's preferred gauge, topped out at 5.6%. Remember, CPI was 9.1. PCE tops out at 5.6% and is now 2.8% versus CPI's 3.4%. So amid all these numbers I'm throwing out, I just want to know from you, Jay, the answer to this highly loaded question: who has worn the drop in inflation better? Is it CPI or PCE?
Well, just one background comment on inflation that most people don't focus on. I think that almost all inflation can be explained by excessive monetary growth and supply shocks, which are usually energy supply shocks.
And we didn't talk about that yet.
Yes, right. But so now we did have a pandemic, so we still have a price shock going on in autos. Auto insurance up 20, repairs is up almost 20. So that is ongoing. So that is a problem with inflation. And in PCE, it's actually a little bit more highly weighted to that auto sector. So that does raise it, and it's lower weighted to shelter. So it's a bit of a grab bag. But the primary problem with both is what I already described, which is the BLS numbers are used by both agencies, by the BEA as well. Yeah. So it's not like they go and say, oh, that terrible agency, they wait 6 months and they just take the data, because they don't have millions of people to go do this twice, right? It would be stupid, in fact. And so that's the primary problem, is that shelter just flat out mismeasured. It was changed deliberately to lower inflation in 1982. They used to basically use housing prices.
Famous case study there.
Right. So it was really a political, that's why it's delayed 6 months, is so it smooths it out. But it makes the Fed terrible at their job, because they
Which is the opposite.
look at it. Yeah, they look at it, like we were screaming, to your competitors and saying, look, inflation's skyrocketing. They didn't want to hear about it. But it was pretty obvious. PPI is running at 10, and those other two measures are running 4 or 5. That's because the shelter component wasn't feeding in.
Can I get an answer, CPI or PCE?
Because it doesn't sound like either of them were better.
I mean, the other thing is core versus headline. I
would say nobody's wearing it.
I think they're both fundamentally flawed. And I think really what should happen is most people probably don't remember Greenspan as the Fed chair.
I remember him.
But he used this thing called judgment. So he would just look at the market and say, oh my gosh, this is a terrible event. He would cut rates over the weekend because the markets were down. So he was using, maybe that's too much judgment, but what really the Fed should do is look at PPI, CPI, PCE, do whatever adjustments are needed if it's poorly calculated, have a wider range. They should be cutting right now because we're at risk. We think we'll have a recession next year if they don't. But they don't use judgments. They're easy to predict because they're very rigid. So I know they won't cut, or believe they won't cut in June, maybe July, because we can tell that, or our estimates at least, are that PCE core rolls down to about 2.6. It's probably not enough for them. They probably want 2.5. But if the labor market's weakening, they'll cut. But so they're easy to predict, but they're basically bureaucratic robots. And so they can lead us into significant problems like they did in 21.
All right. With that warning, on that note, we're going to have to close the show here. We're going to talk about CPI another day. Really appreciate you stopping by here, Jay Hatfield and Brooke DiPalma as well. That's all for Stocks in Translation today.